Well, next up, we have got the fiercest competition that we have had in the history of the Best Ever Pitch Slam. We are really excited. Like I said earlier, the judges have been deliberating. They have been doing their thing. They have been taking their time. I want to welcome up my co-host, the person who's emceeing the Best Ever Pitch Slam. Please give me a warm round of applause for Ben Lapidus.
Set up back here. Like Garrett mentioned, this is the fiercest competition we've ever had at the Best Ever Pitch Slam. We had 13 contestants, and every single one of them got at least one judge's vote, which is amazing. That's never happened before. Usually there's been kind of a clear set of two buckets. Every single applicant, everybody who put themselves out there and did the 4-minute thing, got curiosity from our judges, and all of them were like, these are all pretty good. I might be doing some investing myself. However, we did have 5 groups that stood out above the rest who are here to compete to be the Deal King for the 10th Best Ever Conference and take their pride and their glory for the next 12 months. So without further ado, I'm going to bring back our judges to reevaluate these 5 finalists. Please welcome back to the stage our judging panel.
Let's get it started. Let's get it started in here. Let's get it started.
Good morning, guys.
Let's get it started in here.
And we've got one judge that I saw closing the bar down last night when I went to bed. So he'll join us when he joins us, you know? All right, we're gonna go ahead and kick things off this time. For this round, we're gonna do a slightly longer presentation. There will be a bit of a refresh of content, but there will also be new information delivered. And we're gonna start off strong with Mr. Justin Spillers from Real Estate Alpha. Welcome up, Justin. On the clock.
All right, I'm Justin Spillers. I'm the owner of Real Estate Alpha, founded in 2016. It's an Ohio multifamily value-add company, fully vertically integrated. We have a team of roughly 50. We've bought about 700 apartments all in Ohio, pretty much self-funded to date, me and my business partner. Capital is our only constraint, created a preferred equity fund to supplement our own capital. The fund structure is extremely simple. You invest into our entire existing portfolio, plus you get exposure to all new purchases as well. You're in that pref equity spot, so number 2 in the capital stack, right after the bank. You get a fixed 12% return. We have a unique tax strategy, so it's actually tax deferred until year 9. So there's 12% distributions, you get to keep the full 12%, and then it's liquid. After the first year, just 90 days notice, you can get some or all your money back on your own timeline. Again, that portfolio capital stack, you invest in that middle tranche right after the bank. I have $31 million of my own money in this fund. I'd have to lose all of that first before your first penny's at risk. This is the Middletown, Ohio deal we're buying next. Great off-market deal, 126 units, right in my backyard. Purchase price plus CapEx is about $10 million. We're gonna refinance this with a valuation of $15 million in just 15 months. The cash to close is $2.5 million. I'm bringing half. I'm looking for investors to raise the other half. But how am I going to create $5 million in just 15 months? It's because my team's fully vertically integrated with the sole focus on speed. We do all of our own acquisitions in-house. I have an acquisition manager, 3 analysts. All we do is underwrite 23,000 multifamily properties in Ohio, of which 4,000 fit my buy box. I underwrite 100 deals per month, 1,200 per year. I'm only looking to buy 2 to 3 off-market deals. We only buy home runs. Our leasing team is sales killers. We track our metrics ruthlessly. I have 4,000 leads a month. I know very consistently, every 100 leads, we have 40 showings, 20 show up, 18 applications, 2 new leases signed. I just ratchet up my lead flow if I need to increase occupancy. I have 98% occupancy across my stabilized assets, 95% occupancy even on our value add properties. So our leasing team are absolute sales killers. Property management's all done in-house. We do quarterly inspections. We're going into every single unit every 3 months. We're doing proactive work orders. We're making sure the tenant's not violating the lease, and we're giving that white glove treatment. Our maintenance guys are rock stars. I have 3 of them service all 700 units. They do everything, plumbing, HVAC, electrical themselves. They do it in 48 hours or less. They handle 700 work orders a month, but my construction team is the secret sauce. By way of example, when one of our 700 tenants move out, we put us a 24-hour notice for inspection for wellness. My leasing manager goes in before they move out, does a full video inspection walkthrough, gets the video to my turn manager. We only do 3 turn types now: classic, plus, silver, gold. We have 95% SKU standardization. We do the exact same LVP floor, paint, trim, cabinet, countertop, appliances, bolt-ons, and fixtures in every turn. Our silver upgrade is just a nicer cabinet package, and our gold upgrade is a nicer kitchen package. Otherwise, my turn manager decides with an ROI calculation which turn we're doing. He pre-kits, palletizes all the SKUs, delivers it to the unit at 8 a.m. the day that tenant moves out. My 3-man crew arrives. They work 10-hour shifts. My painting crew works at night. We turn the entire unit in just 7 days. I'm trending for 5-day turns. I want to be at 96-hour turns. Used to take us 3 years to turn a property. Now we're doing it in 12 months or less. All the meanwhile, my leasing team has it 2D, 3D virtually staged. They're doing virtual showings, and a tenant moves in on day 8. We had 111 units we purchased last month. We just closed on it. I added 2 new things to go even faster. We get to turn all of the vacant units during the hold period. So when I put a property under contract to when I close, I get to turn the vacants before I even own it. And then the lease, all the leases that expired during the hold period, they can only renew it from month to month. We turned 11 of the 111 units before I closed at our silver package, had them 2D, 3D virtually staged, and pre-leased before I even owned the property. For the month-to-month ones, we had 42 tenants the week we took over. I met with all 42. I gave them 3 options: $1,000 to move out this week. You can sign a new lease and stay in your existing unit at market rate for 3 months, or you can move into one of our brand new turn units. I met with them in a finished turn unit for a 12-month lease, full market rate. We had about a third for each pick that. That allows us to move extremely fast. We're going to turn 90% of those 111 units in just 8 months. I want to be fully stabilized by month 12, clean T3 by month 15. I want to set Freddie Mac refinance records. That's the goal. We get waivers to do LTV refinances instead of LTCs. We have a really good track record with agency debt. Risk mitigation. I'm a real estate attorney by trade. I am hyper-focused on this. We bring 50% of the capital to every single deal. Super conservative leverage. I only have 55% LTV across my entire portfolio. You invest in that preferred equity position in our entire fund, so you get exposure to all of my cash flowing assets plus future purchases. There's no direct fund fees. I don't nickel and dime you with acquisition fees, disposition fees, a lot of other things you hear. I charge a simple 5% management fee. It's mostly paid through our CapEx loans. Super strict underwriting. I don't fudge the numbers to make it work. I make sure that the numbers in the deal match up to exactly what we're after. And then lastly, the black swan event. When I created the preferred equity fund last year and started taking on private capital, I take that very serious. My parents are the first investors. My sister invests. You'd invest right next to them in that same tranche. Worst case scenario, I want to have a very good backup plan. I could let go of 90% of my staff, me, Brandon, my top 5 team members, a handful of VAs. We could fully stabilize our portfolio, keep it cash flowing, keep the banks paid, keep our investors paid, weather that storm, and then grow in the back end. So extremely safe risk profile with the worst case scenario. But again, to recap, you're investing into my entire fund. Pay a fixed 12% annual return, 90-day liquidity, no taxable hit until year 9. You have a 30% historical cash flowing portfolio to support those payments. I have $31 million of equity I'd have to lose first. That's a 43% reduction in my total value. It's never happened in the history of multifamily. I'd have to lose before your first penny's at risk. No small or large company can outcompete us in Western Ohio. Our entire team is hyper-focused on one thing, and that is speed and winning. We coach daily, we track our KPIs ruthlessly, and we know every single metric, and I get updated every single day. For example, we only have 24 vacant units across my entire portfolio. I just got that this morning. Who's ready to invest?
All right. Justin Spillers, everyone. 4 minutes on the clock. Judges, questions?
I have a quick question on the 90-day liquidity. And I think you hit this earlier, or at least the day before. What happens if there's a run on the bank and you have a large number of investors that redeem, number one? And number two, have you had, in the past, investors redeem out premature?
We've had nobody redeem yet, and we have 5 levers to pull in. Me and Brandon are pretty liquid outside of our fund. We have about $3 to $5 million. I have $3 million inside of the company as well. That's the first lever. Second, we have a lot of low LTV properties. I could refinance those extremely fast. I could sell a property if needed. I could pause CapEx, hoard cash flow. We're very cash flow heavy, or I could find other investors to take that investor out.
And do you have the ability to gate the fund if somebody wants their money out and there's no liquidity?
We're only going to raise up to $10 million, and we have $10 million of our own money, so we feel pretty confident in that. So at this time, there's no gates.
What is the horizon for if somebody's investing it right now? How long before they are fully liquidated? What is the turn?
It's completely up to the investor. They can invest for 1 year, or in theory, as long as we keep the portfolio going, which I plan on doing this for the next 30 years.
Can you talk a little bit about what happens in year 9 with the tax?
Yeah, so the return of tax capital distributions is very unique. You're a true Schedule K1 equity owner of my business. If you invest $100,000, for example, you get a capital account that shows $100,000. Every year I pay you $12,000. It's just a reduction of that capital account just for tax purposes. So in year 9, when your capital account hits 0, then you start paying tax on those distributions, but it's only taxed at long-term capital gains rates.
Is this tax structure, is there an IRS opinion letter or is there case law? Because I like the sound of it, but new tax structures also worry me.
Yes, there's great tax law behind it. Our CPA, Ed Reitmeyer, built the structure out. He's managing director at CBiz. Super well respected in this field. He actually invests with us as well. So if it doesn't work out, you got to yell at one of my other investors. But there's a lot of really good case law on it because we don't have any earnings or profits that pass down to the investor level. That's how we allow to do the return of capital tax distribution.
And I assume, is this like, would you consider this an open-ended or evergreen fund?
Exactly.
So do you have audited financials, and who is your fund admin?
So our fund admin is our local CPA. We do what's called a CPA review, which is one level below audited financials. That's what most banks require to make sure everything ties out. But we're actually going to full audited financials next year because I've had some institutional interest.
Is there a conflict of interest since your CPA is reviewing it and also investing in there?
Local CPA is doing that.
So
Ed
different one.
Reitmeyer is just our fund CPA. He's not our local CPA.
So the return is just 12%. There is no exit bump or anything like that.
It's 12%, but you get the optionality of investing in that preferred equity spot, you get that return of capital tax treatment, and you get the flexibility of investing on your own timeline. So we trade off that upside for a lot of optionality and super safe protection.
How often are distributions?
Every year, December 31st,
Oh, annual.
annually.
So you said you had, I think, a team of 50 is what I saw on the slide?
Yes.
Can you break down where they're located and what divisions they're in?
Yep, we have about 35 W-2s local in Ohio, 15 VAs offshore. Mostly 20 of them are on our turn team, 5 leasing team, 1 accountant, 1 community manager, 2 kind of miscellaneous, and then I think that's everybody.
What's your
Our
leadership?
acquisitions team too.
What's your leadership team and middle management team look like?
So me and Brandon spear up our 6 divisions. They roll up to us, but we have 4 really good managers that oversee those 6 divisions, and then the rest of the team below them. So we have a 3-tiered structure. I'm trying to get myself out of the day-to-day as much as I can.
Is there an on-site manager on each of the properties?
No, we have a floating community manager that rolls into our VA team, but we have people of those properties all the time. So all of our leasing managers and all of our turn guys know exactly how to direct them to get their answers.
How often are you or Brandon physically at the properties?
Every day.
How often do investors see financials?
Anytime they ask, but we do quarterly reports. We're fully transparent, open book. I have one friend, I send him our lender package every single time we buy a property.
What about succession plans if something happens to you?
Well, there's 2 of us. Me and Brandon
Right.
each know pretty much everything, and our managers are doing really good as well. So I'd like to think our managers could step up if something happened to me or Brandon. If we both died in the same accident, would liquidate and you get all your money back, I guess.
Once again, Justin Spillers from Real
travel in
Estate
the same
Alpha.
car.
Thank you, sir. Well done. All right, next up, we are going to bring back to the stage Brian Kerr from Snowball Development to talk about his industrial deal. Come on back, Brian.
All right, I'm Brian Kerr, founder of Snowball Developments. For those that were here yesterday, we're going to kind of speed through most of these slides and try to get a little bit more into the details of the deal. So, sorry, I'm going to go back. We've done 15 acquisitions over the last 4 years. We now have a team of 5, mostly focused on asset management. We've outsourced all of our property management to Lincoln Property Company and Greek Real Estate Development in New Jersey and Connecticut. This acquisition is 2 assets, one in New Haven. It's a flex industrial asset, fully leased by a company, Industrial Flow Systems. They have proprietary valve production technology, really great, company. They bought this building, fully renovated it, and they've been in occupancy for the last 5 years. The second building, 790 Marshall Phelps in Windsor, right beside Bradley Airport. This building is almost fully occupied by Walgreens. It's a supplemental facility for their 800,000 square foot primary distribution center in the market. They've actually receded in the market. They gave up a 500,000 square foot facility. So this facility is very important for returns in a peak volume. The 2 properties are right on I-91. What makes Connecticut a really interesting industrial market is that there's really only 6 roadways for trucks that can transit from New England down into the New York City, New Jersey region. And so it's very predictable where all of the industrial demand is going to. And right now, with Boston and the Westchester markets being north of $20 net rents, the rents that we see in Connecticut are anywhere between 4 and 10. So it's a natural gentrification play into the middle of the state, which is where we've been clustering our portfolio. So on this deal, we have 2 assets, 3 tenants. It's fully leased. It's got a nice weighted average lease term. We've been able to get very great debt to work with this transaction. a staggered lease expiry schedule. Our real defense is that the rents are about 38% below existing market rent. So in any situation with all of our tenants, good news if they can't stay with us, but ultimately our goal is always to retain tenants and have them grow their rent with us. We've got a great basis. It's under $120 a square foot. The cost to build in this market is closer to $160, $180. So again, a lot of protection from that realm. We love to buy low site coverage properties. Our real focus here is to buy the dirt. We want to see the zoning. We want to see the shape, the size, the accessibility, and the political climate that allows us to be really great operators of assets. We've modeled out returns just under 16% to the LP and a 2.6 equity multiple on this $15.1 million capital stack. As I said, there's a nice balanced tenancy expiry schedule here. The first opportunity is a 10,000 square foot renewal. We have that broker from Cushman & Wakefield already sending us the renewal terms that they'd like to see. We'll negotiate with them and try to get that done. Then you have Walgreens that have a 3-year fixed renewal option below market in 2028, 2029. We expect that they're going to exercise that. If they do not, that is our first value add opportunity to re-tenant the property. Walgreens is paying $630 a foot in a $10 market. It'd be a wonderful opportunity if they don't make it or don't need the space. And then finally, Industrial Flow Systems is the real anchor of this portfolio. They have a lease until 2033. They also have a 5-year fixed rate renewal option that they must exercise 12 months before their lease expiry date. The moment they hit that, we will be on the street with a broker, books ready, going to market to maximize the opportunity to leverage that renewal and moving forward on a sale process. Here's our debt terms, really great CMBS. I'll blast through this because I see my time's running down. Our portfolio sees us come in at a 6.4 yield on cost, getting to a 10.5 yield on cost by that IFS renewal. Deal sensitivity analysis, we're really kind of like in the mid-teens here, and that gives us a tremendous amount of protection subject to a lot of the sensitivity that we're running. Now, I had a question yesterday about alignment. It felt like there was like a question around how much money we were putting into the deal. And so this is a Canadian thing that I put into our LPA agreement, and I'll let you read it, particularly point A, because this is how we treat our LPs. We will always look after everyone's best interest. So here are the fundamentals of the deal, and we look forward to your questions.
All right, round of applause for Mr. Brian Kerr. 5 minutes on the clock for Q&A. Judges, questions?
What did that, the last thing you put in the agreement, what was the result? Like, what's the purpose of that? I know it's to show alignment, but what were you saying there? I didn't get a chance to read it.
Can I go back? Hold on, I'm trying to go the wrong way.
As far as the alignment?
Yeah, I'm going the wrong way. So I've actually had most of my counsel from general partners, co-GPs, they have asked me to strip this out. They think this is too fair to LPs. They don't think that we should actually put this in our agreements. And I absolutely say we must put this in our agreements because this is the way we put our foot forward. So we are exercising our powers always in good faith and in the best interest of the partnership and of the partners as a group. I don't think a lot of people put this in these agreements, and I hear it all the time because people, my partners, say, wow, that's new.
Brian, what's the sub-market vacancy for industrial?
For New Haven, it's less than 2%, and for Windsor right now, with the recent new deals that have been done in brand new buildings that have been constructed, it's less than 1% for buildings over 25 foot clear.
So I was the one yesterday that asked about your guys' co-invest, and I think you said the family office was 75%, which I have no issues with. Family offices can be great oversight. They do their own due diligence on you. But what type of control rights do they have over you and the whole assets and ultimately us on the LP side? So
in terms of major decision rights, it's going to be major leases, it's going to be refinancings, it's going to be the exit, the major three. And I mean, these are all very important and easy decisions to take. I would like to say also that the GP, the co-GP that we have on the deal is a lead investor in our GP investment fund. That is not going into this deal. It's because it's fully deployed and it was a value add fund where this is a core plus investment. So this is kind of like an interlude deal between us doing GP Fund 1 and ultimately raising GP Fund 2.
Ryan, I have a couple questions about the Walgreens release.
Yep.
So in the projections, does that assume that they renew or that they leave?
It's a projection that they renew and hit their fixed price renewal option because it's at $675 a foot, market's 10. I would love for them not to.
Got it. Now, if they leave, what sort of, how long do you think it would take to release? Do we have TIs in the budget?
Absolutely. We got $5 TIs. We've got running CapEx that is through the whole portfolio. And then ultimately, it's a 9-month downtime to be able to achieve a market rent.
Piggybacking on that question, do you have relationship with brokers and the market?
So we own 10 assets in Connecticut, and we have been very strategic in how we have given out leasing business, particularly in Hartford. Sean McMahon, who actually represents Walgreens, represents us on an iOS development site and is about to pick up another listing.
Is there any concern that there was maybe overbuilding a couple of years ago and some of those construction starts might hit the market and change the dynamic if there was a vacancy?
Well, Connecticut was a really interesting case study of being too late to the party, so no party, no hangover. It really wasn't doing a lot of speculative development. Some buildings did get built, and then a big building, Wayfair, pre-leased 1.2 million square feet, never occupied. It's been on the market for sublease as a bit of overhang. Walmart just acquired it for $180 a foot.
So I think I saw one of the slides, there was something about solar leasing and some other ancillary leasing. Are there other revenue streams or legacy leases or purchases that you have to serve?
I'm glad you brought that up. I have one more thing. We have just now executed 3 leases actually, for these 2 properties. John Murphy is 2 buildings, and so that we get a small building on each of those separate buildings on separate plots. So we're actually able to generate incremental $102,000 of revenue that's not currently in my model, and that ultimately would boost LP returns closer to 18% and a 2.8 equity multiple.
Is there any impact for the future buyer when you exit? Do they get to take the lease, or is...
It's a lease, so we don't like to do any of the deals where we have to worry through the incentives and any of the power purchasing agreements. This is just a flat out, we deliver a roof to a solar tenant. The solar tenant then is responsible for doing all of the interconnection work and building the solar system and doing all of the agreements with Eversource, who's the utility, and they just pay a rental stream. So we've done this 13 times now across Connecticut. It's been a pretty fluid structure with this developer.
On the solar power purchase agreements, who has the liability?
We don't have a power purchasing liability. We don't have a power purchasing agreement.
But you have the liability for the building itself. What if there is a fire? Because of the solar equipment.
If there's a fire, there'd be insurance proceeds.
Awesome. Brian Kerr from Snowball Development, everyone.
Thank you.
Thank you, sir. All right, folks, let's keep on rolling. Back to our private equity play. Please welcome back Reed Goosens from RSN Property Group.
Let me tell you. You my little boo thing.
All right, guys. So most of you saw this yesterday. So what I'm going to do is quickly recap. I've got 5 minutes here to talk about the opportunity. I'm then going to go dive deep into how we're going to unlock that value. Quickly going to then finish up with some investor returns and maybe answer a question around why a multifamily operator is getting into CPA firms. So as I mentioned yesterday, we have about $1 billion in transactions in multifamily. We think buying inefficient businesses and institutionalizing them is the go right now, and CPA firms are that today. There's a lot of fragmentation, and we can roll that up and create a lot of efficiencies. In terms of what we're doing, we're buying below $3 million EBITDAs because private equity doesn't want to touch them, and so we want to serve them up a feast. And where our goal is to do, I'll skip a slide here. Our goal is to raise a $15 million fund. We're going to be buying between 10 to 15 of these firms, creating a nationwide platform through cross-selling between individual firms, to then roll it up and sell it and serve a feast to that private equity at a 10 to 12 multiple. Now, in terms of the capital stack, I mentioned this yesterday, all the sellers of these firms are rolling over 20% of their equity into AFG, so they are partners with us along the way. It aligns interests and it aligns what we do in terms of exit. Now, I mentioned we're going to serve it up to private equity, but the real thing that I want to touch on is how we are going to unlock that value. Now, CPA firms, the biggest thing is not the attraction of a client to a CPA firm. If you have a good CPA firm, clients are coming out the wazoo.
it's actually attracting talent. And our number one goal is to continue to attract talent, always be attracting talent. We're going to do that through creating a nationwide platform, through creating internships from people coming out of university. But the next thing we're going to be doing, overlaying, is AI. AI, in our opinion, is a huge disruptor in the CPA space. And we think that is going to make our existing people that we acquire more efficient in doing their jobs, and which we think is really where the biggest profits lie. Now, in terms of the flywheel, people are asking, well, why would you be doing this as a multifamily operator? And we're not done with multifamily, but we need to pick up something else. And we've found that retail investors are interested in other things outside of multi. We've partnered up on another deal we did with another sponsor, a family office out of LA. They are a CPA firm, and we saw through them and the ability of how they raise capital. We thought to ourselves, why wouldn't we go and do this M&A roll-up and have an ability to have in-house our own retail investors on tap? So that is why we're doing this from RSN Property Group. In terms of the investor returns, as I mentioned yesterday, we are targeting between a 25 and a 30% IRR, fantastic cash flow, and the way in which this is structured, that there's going to be both Class A and Class B, so if you're a fund of funds, you're interested to get involved, we can handle that. But your money does sit above both the seller rollover money, and it sits above us as GPs. Today, we have acquired 2 firms in the passive losses we can come back to. We've acquired 2 firms, one in New Jersey and one in LA. We've got 8 other firms under LOI right now, so the fund is really trying to kick off. And we're really trying to focus on creating that nationwide platform, focusing in both in California, the Northeast, and in Texas, because that's where a lot of concentration of CPA firms are. The last thing I'll say before bringing it all home here is that there's a massive cross-sell opportunity. So we're not just also doing CPA firms, we're doing other business services, financial services. So think about bookkeeping, we're actually talking to a CPA firm with their broker-dealer license, so we can have a really ecosystem of cross-selling between all the firms, so we can create value for that next private equity buyer. So with that, if you do have any questions, please scan the QR code on the board, because that is where you can go get the investment deck. And I've got a minute left, so we can get straight into questions and get a little bit more.
Q&A. Reed Goosens, everyone, the one and only. Judges, questions.
You talked about the sellers rolling over about 20% of the equity.
Yep.
Where is that sat in the capital stack with the LPs and their common equity? Is it side by side, or in front of us, or behind us?
Behind you guys. Behind you guys. So it's Class A, Class B. If you invest $500,000 more, you get slightly better metrics on the back end. We've also got the Class A, which is a $50,000 investment. Then you've got Class C, which is the seller rollover. They will get paid after they get the pref, which is 12%, plus they get their money back. Then the seller rollover gets their equity back. Then the GP gets the profit.
What % of the business is tax prep, tax advisory?
Very good question. Very good question. Because we are only focusing on, or not only, we're really sensitive to the percentage of W-2 returns. W-2 returns, every CPA is going to have them, but we don't want to see over 30% of that in their business, because let's be honest, W-2s and those returns are where the AI is going to be most prevalent. What we're focused on is businesses or CPA firms that have a lot of business work, so we can cross-sell them with advisory work, estate planning, and bookkeeping. That's where we think the special sauce is, and those clients as well are going to have tax problems, so we can come over the other side of the Chinese wall and look at RSN as a potential investment for tax shelter of some of their income.
With the 8 firms that you have an LOI out on, how long is the turnover process between the LOI and when you close, and then the implementation of kind of the value add and the AI? How long does that?
Yeah, good question. And LOI is just really. Yeah. Unlike in the real estate space, I'm not sitting at the table with 6 other buyers, right? We are actually, and I should probably answer another question before I get into that. The way we're acquiring these firms is literally through Facebook marketing. So we're getting these firms, older generation people are on Facebook, they're coming to us off market. We do have a buy-side advisor and a broker. So they're coming to us with a problem. They want to sell. Now, just because they're under LOI doesn't mean that we move forward. We've looked at 60 firms in the last 2 years, and we've only transacted on 2. And the real reason is because it's about culture. We don't want, the majority of the firms we look at are, I'm done, I'm one out, and it's key man risk. We need your top line revenue with 6 people. They've been in existence for 35 years. They do not have an online payment system. They still accept checks. They don't do any marketing. They don't have any, their website's garbage, and they've got their profits are over 35% in EBITDA multiple. So just coming in and adding very basic stuff, incremental changes, is gonna shift the puck a lot down the ice. I'm not looking for 20% year-on-year growth. I'm looking for very, very achievable growth within these small sub $3 million EBITDA firms.
What kind of due diligence do you do when you're buying these, and do you have an investment banker on your side?
Yep, so we do a quality of earnings, and that's a third party, and it's all making sure that everything is under QOV. That is our biggest thing, and we've got into LOI on probably 6 firms right now, and we've had to walk away. And the beauty is that we're not no hard money. There's none of this stuff that we're going to lose. It's just, we've spent $30,000 on a QOV, and sometimes what the seller's pitching us is not necessarily what happens in reality, and we've got to walk away. So we've been quite methodical in how we're approaching it, and this is not a blow and go, and I want to get to 10 firms in the next 12 months. Like we're planning on doing maybe 2 to 3 acquisitions a year. It's slow and steady wins the race, in our opinion.
What does the competitive set look like in this space? Like how many other guys are in these firms?
And I don't have the exact stacks in front of us, so I have to get it from our buy-side advisor. There's only been like a handful of transactions of sub $5 million EBITDA CPA firms.
You keep going.
Sub $5 million in the last 12 to 24 months. So there isn't a lot of competition, and that's when we're offering seller rollover, equity in the deal, and we can show the sellers that if you roll over $1 million, your $1 million is now going to have a 3 multiple on the end. That it's pretty enticing for these folks.
I'll give you that extra minute for Ash.
Sorry, you gave the seller a lockout period. When you get acquired by private equity, what percentage or what amount of time do you think there'll be a lockout period for?
So right now, to answer your first question first, we have all the sellers are going into becoming employees, and they're a 5-year contract, and they have earnouts related to that 5-year contract. So if they leave, part of the capital stack, and say if I paid $8 million for a deal, say $600,000 of that is an earnout, right? And if they don't stick around for the full 5 years, they don't get that full $600,000. So that's one way we do that. In terms of the exit on the next go around, it's something I'll have to get back to you on, because we haven't really thought that far ahead about how these folks are going to be treated when a private equity comes in. But more than likely at that point, the key man risk will be eliminated, because that's what our value add is. We want to come in and bring in the C-suite and the CEO. So if they do end up going away, and at 5 years, hey, thanks a lot. We've created the system and the platform, so it's not as much of a risk anymore moving forward.
All right, Reed Goosens, everyone.
Thanks, guys.
Let me tell you.
All right, we're gonna bring it back to multifamily. Our family favorite group, the Basis Boys themselves, Joe and Levi from Cowboy Capital.
Don't stop, keep on doing what you're doing. Gotta keep moving. Don't stop, keep on doing what you're doing. Gotta keep moving. Don't stop.
All right, good morning, everybody. We are excited to be here in the finals to present Cowboy Capital and our deal in San Marcos.
So yesterday I butchered the answer when Chris Reese asked why multifamily, so I wanted to redeem myself and give a better answer. Fundamentals are really strong in all the markets that we buy in. It's a buyer's market right now. Values are down 30 to 35%. Affordability is the strongest it's been in a very long time, as rents have been flat to negative over the past 4 years, while wages have steadily increased. We're becoming more of a renter nation. The disparity between rent and buy is 50 to 100% more expensive on a PITI payment to purchase versus rent. You can buy below new vintage assets below replacement cost. The contrarian view, as you can see, some of the OGs here, some of the best at doing that, buying when others aren't, and when others are pursuing other asset classes, or because it's hard to raise equity right now for multifamily because of how it's performed in the past, not the future. And then a quote that I really like by Howard Marks: the worst of loans or deals are made in the best of times, and the best of loans or deals are made in the worst of times. And then San Marcos has exploded its population growth. Over the past 15 years, it's doubled in population, and it's projected to nearly double over the next 10 years. And there's been a lot of deliveries, but everything is getting absorbed, and there's only 2 projects, 473 units currently under construction.
Yeah, and one thing I want to get to before we get into the deal directly is going back to our relationship with our investors. In Cowboy Capital, the last 10 years that we've been doing this, we found that communication is key, and one of our values is we run out the bad news and we walk out the good news, because there's been so many times that investors haven't been told what's going on. So a couple ways that we do that, as you can see on the left, we have a monthly newsletter that we send out. We send KPIs and dashboards and a really detailed outbreak of renovations and operations. We also have an asset management plan, which is unique to Cowboy Capital that we created. Instead of an OM, we've been creating these asset management plans while we're under contract and in due diligence that clearly outlines the roles and responsibilities of everybody involved with the property and goes into great detail of our business plan, our construction, down to the specs and the timeline of the renovations. And lastly, we have a YouTube channel that is, I think, also unique to what we do. We found that the spouses of our investors don't like reading the newsletters, but they like to see and visualize renovations being done and progress happening. Oops. So we're buying these two properties, Post Oak. We're rebranding them as Ranch at Post Cliff.
So yeah, we kind of already gave a summary yesterday of this property high level, but something important to note is we're bringing in our management company prior to closing. They're gonna be able to control the turns and maintain occupancy and mitigate risk up until the closing point. That we already got the seller to agree to that and the seller credit.
Yeah, so we had a couple investors come and ask us, well, what are you guys doing for renovations? And to follow our business model that we've done, the last couple of years, we usually renovate about 50% of the units because we hold for 3 to 5 years and we want to leave some meat on the bone for the next guy. So this property, most of the units look like this with the nice wood cabinets. So they're in pretty good condition. So we're going to be doing pretty much light updates going forward. As far as exterior goes, we have like really good bones. It's in really good shape. It's just dirty. It needs to be cleaned up. So a bulk of our exterior renovation is going to go to curb appeal and to making it nice, clean community for our tenants. One thing that I want to point you to is the monument sign. As you can see, our monument sign is very different than everybody else's. We like to be unique to our brand. So we'll have that archway, Ranch at Post Cliff, as you drive into the property. And as you can see from the other bullets, we're going to be doing a lot to really clean it up and make a nice, clean, safe community for our tenants that they love and appreciate and treat as their own.
And then the rent comparables, they range from $1.40 to $1.60 a square foot. Our in-place rents are barely over $1 a square foot. So there's about a $200 to $250 rent delta, just bringing rents to market without renovating or doing anything. And then the sales comps, I'm not gonna go into these, but the property would be valued at about 90 to 100,000 a unit if the rents were at market currently, and we're buying it for 58,000 a unit.
Yeah, and in the spirit of transparency, this is our total budget for our costs that you can look at, take a picture of. I want to point your direction to the investor splits. We have 3 different classes, ranging from 16% IRR to a 20% IRR. Again, we highly value our investors, so you can see the Class B shares for return investors. If they came in with 50, 100, we're going to give them the benefit and give them the Class B shares. So, and then as far as the top employers in the area, we have a very diverse industry ranging from retail to healthcare to the Texas State University Amazon warehouse. So it's a great area for employment.
Awesome. Joe and Levi, everybody. Judges, questions?
Yeah. Thanks for the presentation. I have a couple questions. One is on, well, first a couple clarifications and a couple questions. So 117 units, 83 in 1997, right?
Yes, sir.
How many were built in 83 versus 97?
So one building is 58 units, built in 83, and then 59 in 97.
Got it.
About half and half.
A half and
Yeah,
half.
pretty much.
Okay.
Yep.
And your current portfolio, I remember from yesterday that you have another deal down the street.
Correct.
Remind me, how long have you owned that other deal?
We bought it September 26th of this last year.
So you just bought it, okay.
Yep, 292 units.
And it's managed by a third-party property management company?
Correct.
Got it. And these are that property, and these two would be your only two in Texas, is that correct?
Currently.
We've exited other deals in San Antonio and
Okay.
DFW, but currently, yeah, those are the only properties in Texas.
So these won't be our first deals that we've done in
Okay.
Texas. So.
And was those exits using the same management company?
No, no.
And where do you two live?
About 3 hours north.
Idaho Falls.
Idaho Falls.
In Utah?
Idaho.
Oh, in Idaho.
Yeah.
Okay, got it. So, and then last clarification, I have a couple questions. And rent comps, I saw the rent comps. I heard that there's room to, you could increase rent if you don't do renovations, but the business plan is to put $6,000 a unit into it, correct?
Yeah, right now, we're going to just focus on doing turns and doing like a $2,000 to $3,000 renovation just to get them up to snuff so we can get our occupancy high. And
okay.
So, but we'll get to
It's a very minimal renovation. Yeah. Flooring on turns that need it. All the cabinets were already replaced.
So those, and once those renovations are done, would the rents be higher or lower than those rent comps that you showed us?
So those were to the market once we do turns. So the rent premiums will be higher when we actually renovate.
So there'd be a different set of rent comps that would compete with the
Slightly. There's not a big delta right now in the renovated units versus classic, like $50 to $100. But once the market firms up, we think that'll be a greater delta.
And that's why we're focusing more on the turns than doing full renovations, because we just don't get the ROI right now on the full renovations.
Okay.
What is the current occupancy?
What's that?
The current occupancy?
It's 73% right now. And that's why we're getting our property managers involved, because it's been run, 20 years by a brother and sister, and they don't really know what they're doing. So our professional management company is going to come in and help get that up before we purchase.
So currently you're going to get it financed through a bank. Is there a plan to refinance it once you get it up to 90% or something?
Yeah, we would plan to refi into a Fannie Freddie as soon as possible.
How often do you guys visit or plan on visiting this property and your other assets? Because I think you got a lot north and south, right? And you guys are in Idaho?
Yes, sir. Yeah, I mean, we were there 2 weeks ago. We were there back in November.
As much as we need to be, hopefully not super often though.
Well, what would cause you to go down there? Is it when there's a problem, or are you down there frequency? Like, who from the leadership team or management team, not a third-party manager, is down there walking the property?
So our construction manager, Doug Martin, he's based in San Antonio. He's a builder developer. He's done syndications before. He's partnering with us on this deal. He's a part of our 292 unit. We just had a car drive through our building at our other property, and he took care of it. So we have a lot of faith and confidence in his ability on site.
Thank
awesome.
you.
Joe and Levi, everyone. Cowboy Capital.
Don't stop, keep on doing what you're doing. Gotta keep moving.
All right,
Don't
thank you all
stop.
for sticking with us. We're going to round this out with our very last finalist back in the retail development space. Please welcome back Joesh from Malabar Hill Capital.
Good morning, everybody. Glad to be back up here. I think they saved the best for last, and I'm going to tell you why just here today. So, just as a refresher, I'm with Malabar Hill Capital. We're laser focused truly on one approach. We go into master plan communities, we buy their commercial reserves, and we develop neighborhood shopping centers from the ground up, get them 100% leased up, and then immediately look to sell them, rinse and repeat. We really truly keep it simple, because we believe in being a master of one versus a master of none. The infrastructure is brought in by the master plan developer. They deliver the roads. Typically, they put the detention requirements in the communities themselves. These are all triple net leases. Around 10 years is kind of where we land. And so we don't expose our investors to operational expense volatility. And then the demand is already built in. We're not here to guess if homes are popping up or not. These master plan developers, they have much deeper foresight and much deeper pockets than Malabar Hill Capital, and so we leverage their expertise in terms of future growth. We do exclusively tilt wall construction, and so we've insulated our projects from macro volatility. Our materials are mostly concrete, which is always locally sourced. I'd be remiss to not plug this in, but I did my 19 miles yesterday. I ran my 20 miles this morning. I'll run my 21 miles tomorrow. And if you guess, I'll also be developing neighborhood shopping centers in master plan communities tomorrow, because we're all about disciplined execution at Malabar Hill Capital. Now, a lot of the pitches that I heard here today, you own the real estate or you're investing in the real estate, but then you have to run the operations within the four walls of the asset that you've invested in. You've now duplicated your risk. We don't believe in that, right? We partner with experienced regional, national, strong credit franchisees. They know how to run their businesses. We're B2B, we're not B2C. They build out their own spaces. They spend hundreds of thousands of dollars to do so, and they're heavily invested in this space early on. We look to sell in such short order thereafter that our vacancy rate risk is quite low. And these are typically e-commerce resistant, what I like to call Amazon-proof tenants. I mean, your dentist, your nail salon, coffee shop, pizza shop, all businesses that you and I use, quite commonly throughout the month. Our current offering is called the Market at Valencia. It's in a city called Manville, Texas, in South Houston. We're already active in this market just across the street. Our Meridiana project is about to ground break next month. It sits at 50% pre-leased, $33.50 signed leases in hand. We've underwritten the Valencia project to $32 per square foot. You do the math. The Valencia community is done by Hillwood Communities. They're Perot Communities out of Dallas, very prolific developers within the state of Texas. And so, if you don't believe my due diligence, certainly let's have lunch with them. Now, what we don't actually advertise to maybe what I call a non-sophisticated investor is that we phase our developments. So we permit and entitle all of the land up front. There's virtually no entitlement risk. And then we deliver half of it to control market velocity, leasing velocity. And once that gets closer in phase one to about 80% or so full, we then deliver phase two and then subsequently look to sell. But truly what this gives us is the option to exit earlier and return capital earlier, but we're in the game to sort of under-promise and over-deliver. Now, we're raising $5.45 million of equity. All of our projects sit completely independent of each other. There's no cross-collateralization of dollars across any of these. Our exit strategy is always very clear. Our minimums are 50. We're a very fee-light company. We charge 1% of the equity raised per year, so about $54,000 per year. We do not take it out of investor equity. It is a line item that's baked into our development loan, and it's something that we request upon and draw upon from the bank. Now, out of the $5.45 million, $4.7 goes into land on day one. The remainder is used for soft costs. We then take out a full recourse, personally guaranteed development loan that covers everything from construction through the end of the project so that you can rest assured that you're in a position where no capital calls will be made. Our target is about 48 months end to end from land acquisition to disposition, and the returns that we show you are as if we were building both phases and selling both phases at the same time. We don't have any algorithmic hurdle rates or waterfall structures. We keep it very simple. That's our operating memorandum. It's return of equity plus an accrued 8% preferred return that has to be paid out upon sale first, prior to a 50-50 profit split. And I've gotten a lot of feedback. It's a very common question, 50-50 is too rich for me. But truly, look at the skin that we have in the game, compare it to where you see 70-30 or 80-20, and you'll start to see why it makes sense. Investor experience, your typical quarterly project updates. They include portfolio updates as well, annual financials, K1 tax documents. You'll get depreciation in the latter part of our life cycle, but we value honesty. We don't pitch this to you as a tax play. This is truly value creation from the ground up. We control all the variables. We're not acquiring assets and hoping to force appreciation. We're Texas-based, come down, we do a lot of investor-only events. We do about 6 to 8 projects a year, and all of our investors that are current, we have about 500 or so, get to look at those before we put them into the public space. And from time to time, we release projects fully internally that never hit the public space as well. That about wraps it up from my end. I'm really glad to be back up here and happy to answer any questions.
Thank you much, everyone. Judges, questions?
Out of the 5.45 that you're looking to raise, remind me, how much have you raised currently?
Yeah, so I actually haven't pushed this to my public network yet, but I have about $2 million in soft commitments.
Okay, and then on the leases, what's the terms on your typical tenant lease? Is it
Yeah,
long-term
yeah.
lease?
They're 10-year absolute triple net with nominal 2 to 2.5% annual escalations.
Okay.
Are you? Go ahead.
What kind of cap rate are you assuming on the exit?
6.5%. We build at a 9% cap, so we have about a 250 basis point spread. So quite a bit of buffer in our projects.
Are you buying and building before the homes are built, during, or after in the subdivision?
Yeah, we wait for a few homes to be built, but since we're a 4-year life cycle, typically a majority of the homes are being delivered as we're concurrently delivering our shopping
When you say a few homes, is that 5%, 10%?
No, so we operate in about 3,000 to 5,000 home communities. We look for about 1,000 homes to be delivered before we bring our projects out to race.
Okay.
Yep.
What have you budgeted for TI per tenant or per
Yeah,
square foot?
yeah. It's all negotiable, of course, but I don't know that number off the top of my head, to be honest with you. Yeah.
Can you talk a little more about your pre-leasing process? Do you do that
Absolutely.
in-house?
Leasing is an art in and of itself. We don't pretend to be masters of that, and so we use big leasing companies. All of those contingencies leasing commissions are built into our development budget. In Houston particularly, we use a company called Reed King. If you're familiar with Texas, H-E-B is our beloved grocer. Reed King has 3 clients, H-E-B, Crow Holdings, and us. So they bring us the tenants.
You had mentioned on the 50-50 waterfall split, some people don't like it, but then you said look at the skin in the game. What's the skin in the game you have?
Absolutely. We invest in the same class as LPs, 5 to 10% of the equity stack in all 28 plus projects. And then it's a full recourse personal guaranteed loan on the development loan side. In order to get those loans, we have to hold significant liquidity positions at the banks that we work with.
Okay. What type of extensions do you have on those loans if they take more than 4 years
Absolutely.
to execute?
We always have a built-in conversion to a mini perm loan at the end of year 4. And yeah, so.
And how many have you gone full cycle on?
Yeah, so we started in 2021. Our first 3 land acquisitions were in early 2022, 100% leased up. Forced sale with CBRE as we speak today, 2 publicly traded companies looking at portfolio purchases of all 3. So it's just a function of time.
Do you have an LOI from them?
We are negotiating an LOI for that. Yeah, we've raised for 25 other projects between then and now.
I'm assuming these are interest-only loans and you have built-in reserves for paying the interest?
24 months, interest only, interest reserves built into the loan itself, but we typically cash flow at a certain point and don't draw down upon the full reserves.
On a full recourse loan, the lenders are okay with you having only 5 or 10% into the deal?
Yeah, that's correct. Yeah, well, we work with regional banks and they've been okay with it so far.
What's your basis per square foot compared to your sales price per square foot underwritten?
Yeah, so I know it off of a cap rate, kind of the spread between that 9%, 6.5%, but I can tell you this, is that we competitively bid 3 to 4 projects at a time, and our tilt wall construction prices are the same as if a developer was doing prefabricated steel.
With the 2 phases, how much of your energy is on actual operating versus development?
Yeah, I mean, we virtually don't have any operating responsibilities. The businesses that come into our 4 walls, they're doing their own operations. We do property management in-house because we need to push them to get their spaces built out because that's fundamental to the sale of our asset.
You mentioned that you have a lot of like the dentists, the Amazon-proof tenants, and those are smaller tenants, smaller balance sheets. Who are your bigger like anchor tenants?
Yeah, I mean, we have Vision Source. We have Domino's Pizza franchisees with 100 locations, those types of tenants. Very strong sushi restaurants, nail salons.
You can finish up.
Okay, yeah, nail salons, if you can believe it, in Houston, there's actually only a handful of them, but they all just have different names across the spaces. And so in Meridiana, we signed a 6,000 square foot lease in one of our projects there, so.
All right, Duresh, everyone from Malabar Hill Capital. Thank you, sir. All right, well, the judges are going to go deliberate on our 5 finalists. One more round of applause for both our esteemed judges and our 5 finalists. Takes a lot of guts to come up here and do that. Thank you guys for sticking with us. We're going to get back to our programming, and we'll see you in a couple hours with our winners.